Howdy, Jacob here. Today we're looking at TK Tankers, company 122 with our high ROIC screener. Oil, gas, consumable fuels industry, 2 billion market cap on just 1.6 billion enterprise value. Historically, have not gotten a great return on invested capital, but the last 2 years, likely due to inflation, you're looking at some very high earnings and high returns on invested capital. So much so that their operating margin is actually greater than their gross margin was 10 years ago. That's always a wild figure to see and wild comparison, since the difference between gross and margin, if you look at your income statement, includes sales, general and administrative, other operating expenses to get to your operating profit. And so for that to be greater than the gross profit, I mean, in this business, the difference between gross and operating is very little. They don't have a lot of, definitely little other expenses, and then fairly little sales, general, and admin, especially compared to their revenue. Their balance sheet shows 365 million cash on hand, no short-term debt, no long-term debt, and 348 total liabilities. You gotta love that. That's a beautiful balance sheet. More cash on hand or cash-like products than all of their liabilities. Extremely beautiful balance sheet. Gushing cash flow recently, but fairly inconsistent business, very volatile. It looks like the most recent year, they used a lot of money to pay down debt. They're cash free now, so it'd be very interesting to see what exactly they do with this money. It looks like they are paying a dividend now at 1.7% yield, and that is taking up just 10% of their most recent year, but on a 5 year average basis, probably closer to 40% or so of their free cash flow. So it would be interesting to see what this company does if the stock price were to fall. I wonder if they buy back a lot of shares. I do wonder as well if they have reinvestment opportunities and if they are able to get these immense rates of return, or whether it's back to the single digit type of reinvestment. But if a company isn't reinvesting their money very well and getting a high return on it, it does make the most sense to just buy back shares that are very obviously cheap and then just pay a dividend to your shareholders. So let's start making some assumptions here. On the revenue growth side, they grew so much recently. Going back to the 3 and 13, what I'm saying here is that they'll probably have growth relatively in line with inflation. No necessary um, premiums to their price to earnings and price to free cash flow. So I'm actually putting a slight conservatism based on the end of 7 years. Will the growth still be like inflation, or whether it might be less difficult or more difficult? I think this is the type of company that's probably going to be pretty flat for a couple of years and then go up, or maybe even decrease and then go up due to the fact that it's jumped up so much recently. I do have a hard time thinking that a company that grew 100, whatever that is, 60%, 150% over 2 years through no acquisitions is able to keep that going, especially historically, the fact that that has not been the case. And then for margins, we'll probably do just close to averages here, since it is a volatile business. So I just want to take a rough approximation of where I think the company might be in 7 years, since through a 7 year period, it's probably going to be higher at sometimes, lower at sometimes, but will average out to roughly the margins shown. And then they haven't bought back shares. They will have a lot of money to do so, since they don't have short-term or long-term debt. But they don't have a history of it, so I'll probably keep that the same. And then they don't have a long history of paying a dividend, but I think I'm safe increasing this in line um, with their revenue growth. So right now we're saying that they are either reinvesting a little bit, making acquisitions, with that money that they're not using for the dividend. But again, we don't have that history to be confident that they will be buying back shares. And so, although I do usually like to allocate as much cash flow as I can um, into my assumptions, but here I think we said about 40% of their 5 year average free cash flow is going towards a dividend. I'm going to say that the rest is going towards this 3% revenue growth through acquisition and reinvestment. Hopefully, that gets us to a price that needs to fall 28% before you get the return that we're looking for. Sorry, I was just looking to see what the stock-based compensation was. Doesn't look like there was anything. So I think shares flat without them buying back shares makes sense. And yeah, just a little bit too frothy for me right now. something I would definitely want to do more research on with the business this volatile. It's very interesting because if you look at a PE basis, some companies like this look the cheapest when they're actually the most expensive, and that's due to the fact they have the highest margin that they have in their volatile earnings. But the company's actually cheapest when it is possibly making least or even negative earnings due to the fact that, again, it's a volatile business. When things are great, it looks very frothy. And when things are bad, it looks a little tough. And so businesses like that, historically at least, have been shown to, when the PE looks the cheapest, it's actually possibly expensive. And then when it's actually negative or even looks very expensive, that's the best time to get into those type of companies. But again, we look at things in a long-term perspective. So that's why I'm using averages here. I'm not trying to time anything or whatever, but um, again, just using averages, it still looks a bit expensive here. So hopefully you enjoy the video and have a great rest of your day. Thank you.